Welcome back to the deep dive. You know the drill. We dig into the source docs, the 10Qs, the earnings calls, all that stuff so you get the core insights without the heavy lifting.
And today we're diving into the hospitality sector, specifically Hilton's Q3 2025 performance. Got a good look at their internal reports and call transcripts here.
Right. Our mission, as always, is to give you that quick but really thorough insight. We're looking at Hilton's results, their big strategic moves, and what they see coming down the pike.
Yeah, especially for you, the listener, trying to get a handle on the travel industry's pulse. This kind of synthesis from the company itself is, well, pretty valuable.
Okay, let's jump right in. The sources really highlight this central paradox for the quarter. Hilton actually delivered a strong bottom line. Adjusted EBITDA and adjusted EPS were like way better than expected.
Right, meaningfully better.
But at the same time, their system-wide comparable RevPAR, that key metric, was down 1.1% compared to last year.
And that gap, that's what's really interesting, isn't it?
Yeah.
Because it suggests maybe a shift in how they're running the business. Explain that a bit. RevPAR, that's revenue per available room, the industry standard, and adjusted EBITDA is basically their operating profit measure, right?
Exactly. Earnings before interest, taxes, depreciation, amortization. So yeah, making more profit even when the core room revenue metrics soften slightly.
That doesn't usually just
Yeah.
happen. How did they manage that? Did they just cut costs massively or?
Well, cost control is part of it, definitely, but the sources really point to a resilience that comes from something more fundamental. It looks like Hilton's becoming less reliant just on occupancy and room rates and more on being this massive, stable, fee-generating engine.
Okay, so give us the numbers on that profit.
Adjusted EBITDA came in at $976 million. That's up a solid 8% year over year. And adjusted EPS was $2.11. Both beat their own forecasts quite handily.
And the drivers for that, offsetting the RevPAR weakness, you mentioned fees.
Yeah, two main things. First, really good growth in what they call non-RevPAR-driven fees. Think loyalty programs, credit card deals, other services tied to the brand, not just the room itself.
Yeah. Their management and franchise fees, specifically, were up 5.3% year over year. Very strong.
And the second driver,
Just very disciplined cost control,
Ugh.
keeping a tight lid on G&A general and administrative expenses across the whole company.
Mhm.
So, yeah, they managed the internal stuff really well while the external environment got a bit tougher.
makes sense. So let's dig into that external piece. Why did RevPA dip 1.1%? What were the specific pressures?
It was a mix of things, kind of granular factors adding up. You had some unfavorable timing with holidays and major events compared to last year that always messes with the year-over-year numbers.
Right, the calendar shifts.
Exactly. Then there was softer international inbound travel coming into the U.S.
Yeah.
Also, a noticeable dip in U.S. government travel. And, importantly, they had some hotels undergoing renovations, taking some key rooms offline temporarily.
Okay, so several distinct headwinds hitting at once. How did that play out across the different types of travelers? Leisure, business, group?
Okay, so leisure transient RevPAR was actually pretty much flat overall. Seems like strong demand in places like Europe and the Middle East kind of canceled out the impact of those U.S. holiday shifts.
Interesting. And business travel?
Business transient was down about 1%. The sources chalk that up mostly to, ongoing economic uncertainty. Companies are still being a bit cautious with travel budgets.
And group bookings look like the weakest link, down 4%.
Yeah, group took the biggest hit in Q3. But there's a key bit of context there. That 4% drop was mostly because they were comparing against a really strong quarter last year that had some major international events.
Ah, so a tough comp, as they say.
A very tough comp. And what's really interesting is that the forward-looking picture for group is actually quite strong. Bookings for 2026 are already pacing up mid-single digits.
So they see that 4% dip as more of a blip, not a trend.
Exactly. Management seems to view it as a short-term comparison issue, not a sign of underlying weakness in group demand.
Okay. Regionally then, if the U.S. was soft overall, where did they see strength?
The standout was definitely the Middle East and Africa. RevPAR there jumped 9.9% year over year. That seemed to be driven by really strong travel within that region.
Interesting. Intra-regional strength.
Yeah, suggesting good economic activity there. The U.S., as you said, was the soft spot, down 2.3%. And their outlook for the full year in the U.S. is basically flat RevPAR, which kind of confirms that cautious corporate spending environment we talked about.
And Asia-Pacific? I remember reading something about China specifically.
Right. APAC overall was pretty much flat, down just 0.1%. But China itself saw RevPAR decline 3.1%.
And the reason?
The sources are pretty clear. It ties back to changes in Chinese government travel policies. Those seem to have hit business and group travel particularly hard, especially in the Tier 2 and Tier 3 cities.
Wow, a direct policy impact like that.
Yeah, it's a good example of how local policies can ripple through a global company's numbers.
So putting it all together, what's the RevPAR outlook for the near term, Q4 and the full year?
They're expecting a bit of a rebound in Q4, forecasting RevPAR to be up around 1%. That leads into a full year 2025 projection of somewhere between flat and up 1%.
Okay, so cautious, but maybe stabilizing.
Pretty much. Seems like they feel the worst of the volatility might be over for now.
Stabilizing is one thing, but Hilton's big story is usually growth, massive scale. Let's shift gears from the RevPAR headwinds and talk about how they're building the business.
Oh, absolutely. The scale is just immense. They just hit their 9,000th hotel this quarter. That was the Signia by Hilton conversion down in La Cantera.
9,000 hotels. And didn't they just pass 8,000 not that long ago?
Just a year ago. Think about their pace. To get from 8,000 to 9,000 in a year, they were opening nearly 3 hotels per day.
Wait, pause on that. 3 hotels? Every single day. The logistics of that. Onboarding, quality control, staffing. That's kind of mind-blowing.
It really speaks to how refined their development and conversion engine is. And that engine keeps feeding the future. Their development pipeline is now at a record high, over 515,000 rooms. That's up 5% from last year, and almost half of those rooms are already under construction.
And you mentioned conversions. That seems like a huge part of hitting those opening numbers so fast.
It's absolutely central to their strategy, taking existing independent hotels and bringing them under a Hilton brand that's expected to be nearly 40% of all their openings in 2025.
40%?
Yeah, across 12 different brands. They explicitly state the global opportunity for conversions is, quote, immense.
Which leads directly to the new brand they launched this quarter, right? The Outset Collection. Sounds like it was built precisely for that conversion market.
Exactly. Outset Collection by Hilton. It's their 25th brand overall and their 8th lifestyle brand.
And the target.
It's designed specifically for that white space. They identified upper mid-scale to upscale independent hotels, the kind of unique local hotels that maybe don't fit a standard brand box.
And that's a big market.
Huge. They estimate that segment, unbranded independents in that category, makes up more than half of the entire global hotel supply right now.
Over half. Okay, so the potential is massive if they can tap into that.
That's the plan. They see owners wanting the power of the Hilton reservation system and loyalty program, but maybe wanting to keep more of their hotel's unique character. Outset aims to bridge that gap.
What kind of traction are they seeing with Outset already?
Pretty significant initial interest. They already have over 60 hotels in the development pipeline for Outset.
60 already.
Yep. And they think long-term, just in North America, it could be over 500 hotels. They expect the first few to actually open their doors in Q4 of this year.
So a major new growth lever for them focused on conversions. But even beyond Outset, their global footprint still has room to grow, right? Even with 25 brands.
Oh, definitely. They're in 141 countries and territories, which sounds like a lot. But on average, they only have about 4 of their 25 brands operating in each country.
Only 4 out of 25.
Yeah, so massive runway just to bring their existing brands into markets where they already have a presence.
Any recent examples of that?
Sure. This quarter, they highlighted the debut of DoubleTree in Pakistan, Hampton opening in the U.S. Virgin Islands, and significantly, the Motto brand making its Asia-Pacific debut in Hong Kong.
Okay, so scale, conversions, new brands, global expansion, a lot happening on the growth front. Now, how are they making all this work efficiently? Let's talk tech and AI.
Right, this is another area when they feel they have a real edge. Their proprietary tech platform, which they started building years ago, is now 90% cloud-based.
90%, that's a big jump.
Huge jump. It was only 20% back in 2020. That modern cloud-native foundation makes them much more agile, especially when it comes to adopting things like AI, compared to competitors who might be stuck on older legacy systems.
So how are they using AI? The sources mentioned 3 main areas.
Yeah, they break it down into 3 strategic buckets. First is efficiency, just using AI to reinvent internal processes, streamline things, and cut down on G&A and system costs.
Okay.
Back office stuff, supply chains, that sort of thing.
Makes sense. Standard efficiency play. What's the second?
Second is go-to-market. This is about using AI to better manage their inventory, their room rates, availability, basically optimizing revenue, and also how they navigate the distribution landscape.
Distribution meaning?
Meaning how people book rooms.
Yeah.
With all these new large language models like ChatGPT, Gemini, etc., changing how consumers search for travel, Hilton wants to use its tech to make sure they control that customer relationship and booking process as much as possible.
Right, staying ahead of the curve as search changes. And the third AI bucket,
The third is customer experience, or CX. This is about using all the data they have on guests to deliver sort of mass customization.
Meaning?
Using data to anticipate needs, enable real-time problem solving right at the hotel. Like the system might flag an issue in your room before you even notice it, allowing staff to fix it proactively. Really personalized service at scale.
That tech focus also ties into how they're supporting their hotel owners, right? Especially now with owners facing cost pressures.
It does, yeah. It's a neat connection. They announced this program, they're calling it a first-of-its-kind initiative, where they're actually offering system fee reductions back to the owners.
Giving money back. How does that work?
Well, it's not automatic. The fee reductions are specifically tied to the hotel hitting certain quality scores, product quality, service quality.
So it's an incentive, perform well, meet the standards, and you get a break on the fees.
Exactly. It's framed as sharing the benefits of the scale and technology efficiencies Hilton's achieved, while also reinforcing the need for owners to keep investing in the guest experience.
Especially important now, you said, because owners are dealing with flat or slightly down revenues and higher inflation.
Precisely. It helps owners navigate this tougher period, encourages them to reinvest after maybe pulling back during the pandemic, and keeps the focus squarely on quality, which ultimately benefits the whole Hilton brand.
Okay, that paints a really clear picture of how they're managing the present. Operational strength, cost control, tech leverage, supporting owners. But let's look further out now. The sources conveyed a really striking level of long-term optimism.
Yeah, high confidence is probably the best way to put it. They're projecting RevPAR growth to actually accelerate in the coming years. They explicitly said they expect 2027 to be better than 2026, which they expect to be better than 2025.
That's quite bullish given the current climate. What's driving that confidence?
It seems to be almost entirely based on their view of these massive structural economic tailwinds in the U.S., specifically multi-trillion-dollar investment cycles that are approved, funded, but haven't really kicked into high gear yet.
Okay, trillions with a T. What kind of investments are we talking about?
Three main buckets they highlighted. First, the big federal infrastructure bill. That's about $1.6 trillion allocated, but they estimate less than 20% of it has actually been spent.
Only 20% so far. Wow.
Yeah, these things take time to plan and roll out. Second, the THAPS Act, about $800 billion there, aimed at boosting semiconductor manufacturing. Again, less than 5% of that money is actually out the door and working yet.
Okay, infrastructure, chips. And the third must be AI related.
You got it. The third bucket is all the investment needed for AI infrastructure. We're talking trillions, public and private, going into building data centers, and crucially, all the energy infrastructure, power plants, transmission lines needed to run them.
So they're betting heavily that this huge wave of government and private spending is coming and it's going to drive a lot of travel. Is there a risk that stuff gets delayed, though? That infrastructure bill has been slow.
That's definitely the key assumption. They acknowledge the slow start, but their argument is the money is allocated, it is coming. Once projects move from planning to construction, that deployment phase lasts for years and years.
And the type of travel it drives.
They describe it as a broad-based middle-class game, meaning it's not just executives flying around. It's construction crews, engineers, technicians, support staff needing rooms all over the country for extended periods. It should benefit all segments, not just luxury.
Okay, so a sustained, broad increase in travel demand driven by these massive projects.
That's the thesis, and here's the kicker. That expected demand growth runs straight into a period of really limited new hotel supply.
Ah, the supply side constraint.
Exactly. The industry is currently adding new rooms, new capacity, at less than 1% per year. The long-term average, like the 30-year average, is closer to 2.5%.
So demand goes up structurally, supply stays tight.
That forces RevPAR up. It's basic economics. Even if the overall economy has bumps, that supply-demand imbalance provides a strong floor and pushes rates higher over time.
And are there any specific boosts they're looking at for, say, 2026?
Yeah, beyond just having easier comparisons to 2025, they pointed to a couple of things. The U.S. midterm elections always drive a lot of travel and activity across the country. And then there's the extended World Cup experience happening in that year.
Right, event-driven demand on top of the structural trend.
Exactly. Those provide nice, quantifiable bumps.
Okay, so wrapping this up, it really sounds like a two-part story. Part one is navigating the current choppiness through operational discipline, cost control, leveraging their scale, especially with conversions and new brands, and using tech like AI.
That's the resilience piece, yeah, managing the present effectively.
And part two is this profound optimism about the medium to long term, betting big on these huge U.S. investment cycles hitting a capacity-constrained hotel market.
That's the structural growth bit. Their confidence seems squarely placed on that capital deployment finally hitting the ground across the U.S.
Which brings us to our final thought for you, the listener. This reliance on these incredibly complex, multi-trillion-dollar investment cycles, covering everything from roads and bridges to chip factories to the data centers and power grid needed for AI, it raises a really interesting question.
Considering that the travel demand hinges on the physical rollout of these projects across the country, which specific part of this massive spending do you think will actually generate the most sustained long-term travel demand for the hotel industry over the next, say, 3 to 5 years?
Is it the traditional infrastructure work? Is it the high-tech manufacturing hubs from the Teach PS Act? Or is it the absolutely enormous build-out of energy and data center capacity for the AI revolution?
Think about the kind of work involved, where it happens, and for how long people might need to travel for each of those. Something to mull over.
We'll leave you with that. Join us next time for another deep dive.